This month, which is May, we're only halfway through it, the deliveries are 700% higher than May last year. So someone somewhere is taking delivery of huge quantities of 100-ounce bars. That's 330,000 a bar. Someone is taking delivery of huge quantities of physical bars, and there's been all kinds of speculation as to, one, who it might be or why they might be doing it, but we still don't have an answer, and we're months into this. But those bars are disappearing into some physical vault of somewhere who might in the past have been happy rolling over the futures on COMEX. They're taking delivery. Question is, who are they doing? Who is it and why?
You're watching Capital Cause, and my name is Danny. It is May 20th, 2025, and today's guest is none other than the one and only Clive Thompson. Clive, thank you so much for coming back on the show, my friend.
Well, Danny, thank you very much for inviting me back. I guess you didn't get too many negative comments last time, so
somebody must have. Actually, none at all. It's all positive, especially when you're in the video here, Clive. So let us just dive right in. I want to get your thoughts and feedback on what you think should be front and center for investors right now. For the average investor out there, what do you think should be on their radar screen at this time?
So we're seeing non-stop reductions in the short-term interest rates by central banks in Europe, UK, Switzerland, and also, but not recently, from the United States. But it's very clear that the United States, or at least people think they will have 2 or 3 more reductions this year. But at the other end of the scale, all around the world, the longer dated bond yields, which are the borrowings by the government, the interest rate of those are going up and are pretty close to the highest we've been in decades. So if you look at the United States a couple of days ago, yesterday I think it was, the yield went above 5% very, very briefly. But, you know, people have been saying 5% is the danger level, and we're literally there. So the question that I've got, and I think everybody around the world has got, is what's going to happen if these rates keep rising? I mean, one of the rates to look at, which is looking absolutely scary on the chart, is the Japanese 30-year bond. There, the rate has gone to, I think it's now over 3%, coming from effectively what was near enough zero, which means that Japan has got one of the highest debt to GDP ratios in the world. And what that means is that the cost of rolling over their maturing debt is rising dramatically. So if you look at your chart there, you can see that the rate was down at 0.2%, and now it's 3%. So that means it's gone up 15 times. It's 15 times as much cost in interest terms on the maturing debt. So when your debt to GDP ratio is as high as in Japan, over nearly 300%, that's costing an ever-growing proportion of the Japanese government's income. And we mustn't forget that Japan is a country with an aging population, and therefore the number of people contributing tax revenues will be falling relative to the number of people who are in their old age retirement. So we could get a problem coming out of Japan. We don't know what's going to happen. I mean, the Bank of Japan could step in and start supporting that bond, but that would be monetization, because they'd be printing yen to buy the long bond. And the same thing might happen in the United States. It might well happen that the Federal Reserve is politely invited by Mr. Bessent. So there'll be a conversation perhaps between Mr. Bessent and Jerome Powell along the lines of, come on, laddie, do what you're told, or something like that. And then the Federal Reserve will step in and start to buy US government bonds to prevent the yields from spiraling out of control. Because clearly we've got a problem coming up in probably July or August, maybe a little bit later, when they re-raise the debt ceiling. So on the 3rd of January this year, 2nd of January, the US government hit what's called the debt ceiling, meaning they're no longer allowed to increase the national debt. This is something which has happened over and over again. Every 2 or 3 years, they hit the debt ceiling, and then they have a lot of debate, and eventually they raise it. But the debate often goes to the 11th hour. So it's quite fraught, because the 11th hour basically means if they get beyond a certain point, they might default. They never have, but it has become quite fraught in the debates in the past. So let's assume that they do raise the debt ceiling as they have done in the past, and that happens perhaps in July or August. At that point, they have to replenish the coffers, because what's been happening is to keep paying the bills after they hit the debt ceiling. They've had to run down their cash balances and effectively raid the government pension plans to do so. By raid the government pension plans, I mean they basically stopped contributing what they owe to the government pension plans. But once they get to raise the debt ceiling, they'll have to make the pension plans good by putting the money they should have put into the pension plans plus the missing interest. Plus they'll have to replenish the coffers with about $800 billion. Plus they'll have to finance the budget deficit of a couple of $1 trillion on top of that this year. So there's all of this debt is going to be rolled over, or new debt will be needed, and all of that's going to be at a higher interest rate than the maturing debt at the moment. So the situation is one where the interest being paid by governments, and it's not just the US government, it's the Japanese government, the UK government, and the European government, because these around the world, these long-dated bond yields are hitting, as near as makes no difference, 20, 30-year records. Around the world, the interest burden on governments is going up.
This is very fascinating. Why can't the Fed, what's stopping the Fed from just cutting rates? Why are they so adamant on keeping rates elevated the way that they are? If you were to take Chairman Jerome Powell's sentiment and Donald Trump's opposition at face value, there seems to be a little bit of a discord between the two. Some may say it's all scripted. It's all meant to kind of give Powell cover not to cut rates. But I want to get your thoughts here. What's stopping the Fed from cutting rates here?
I must admit, whilst the market wasn't expecting him to cut at the last Federal Reserve meeting, I must admit I was quite surprised that they didn't take a decision to cut, because there were some clear signs that the economy is about to slow. There's been a lot of job firings from the government, and there were other signs that the spending by the public is falling, which indicate, so they're precursors to a slowdown in the economy. And to head that off, the central bank perhaps should be considering reducing interest rates. Now, of course, their other mandate, which is one of inflation, they're looking at a headline number, which I don't think it's going to get down to their 2% number, but to be frank, it's close enough at the moment. But it hasn't hit their headline number. But of course, the danger is that if they do lower rates, it's quite likely that the economy will pick up, and the inflation will start to pick up at that time anyway. And it's going to pick up anyway because of the tariffs. We know that now anyway. So I think there's a little bit of nervousness from the inflation front to cut the rates, but they really should be considering it from the point of view of the economy.
Right. And you're looking at the inflation rate here collapse as of the top here in 2023. So, yeah, I mean, the narrative is quite odd, because the Fed is usually late in on the game. You can actually do this exercise on ChatGPT or any AI of your choice. You can prompt it to tell you, what were the last several recessions, and give me the reported start date and end date, as well as the actual start date and end date. And what you will find is that the reported start date and end date oftentimes is outside of the actual start date and end date interval, right? So by the time the recession is over, that's when they actually report it, and they're usually very late to the game.
And the funny thing is, there's a lot of recessions which are, inverted commas, predicted, which never happen.
Yeah.
Talking about artificial intelligence, this is going to change the labor market dramatically.
Okay.
I think every company on the planet with any brains in its head, and that would be most of them, must be frantically trying to gear up to use AI. AI is going to make certain individuals 10 times more productive than they ever were. And those who don't figure out how to master artificial intelligence will be left behind. So they'll just become insignificant. So the message I've been trying to give out to people is, if you have a job, don't wait around to see if you'll be all right. There's one thing that everybody should be learning now. It's the new literacy, and it's called prompt engineering. Now, that might sound very complicated, but it's something you can learn in about an hour. It's not very long to learn. But prompt engineering, and I wrote on a post on LinkedIn a couple of days ago, a list of about 26 rules or 26 things you need to know if you want to be a prompt engineer. They're very, very simple things, like giving out clear, unambiguous instructions, checking the output from the from your artificial intelligence when you get it, using iterations where you break an instruction down, you give the first instruction, when you get it back, you give the second instruction, when you get it back, you give the third instruction, so you make it easy for the artificial intelligence to do it in the right sequence. Providing the AI with context. So, for example, you might say to the AI, I want you to be a qualified lawyer, and I want you to imagine that I'm a sophisticated and knowledgeable investor. That's role play. So it gives it speaks in the right way, or answers in the right way to the right audience. And of course, another thing would be, I mean, I won't go on because there's 26 of these, but another example would be give it, when you instruct AI and you want a certain output, give it an example of what you like, what you want, a template. So I want you to, here's my report on IBM. I want you to do a report on Microsoft following the template that I use for IBM. That's very easy stuff to learn, but if you don't get it and you haven't learned it, you'll be left behind when the AI starts to hit your office, because I can guarantee that in many, many firms, the IT department is working already to replace your job. And when I say your job, I'm talking to the people who aren't taking the necessary action to know how to master it. But the implications for investors is completely different. Whilst individuals will lose their jobs, and there'll be a lot of job losses here, for companies, their costs are going to go down. Their productivity is going to go up. And we must remember that AI doesn't spend time by the coffee machine chatting. It doesn't upset the other staff. It doesn't ask for pay rises. It works 24 hours a day, 7 days a week, 365 days a year. It doesn't have kids. It doesn't have sick days. It doesn't need a desk or a chair or a cubicle. So the costs for offices, as they reduce their staff in favor of AI, are going to drop. The rent levels are going to drop. Well, actually, the rent levels are going to drop. They're going to not need so much space anymore. And the net effect is that most companies which have a lot of employees will be benefiting to such an extent that their costs will have gone down, their productivity will have gone up, and that means higher profits. So for investors who want to benefit from this, the magic trick is to identify those companies which can make the largest cost savings and which can make the largest productivity increases thanks to AI. I'm in the middle of this exercise now. I've identified quite a few companies, and some of them they're not. None of them are in the United States at the moment. Of course, there will be plenty in the United States, but I think some of the companies would.
What about the U.S. tech? What about the U.S. tech companies? It would. I mean, intuitively, you would think that the Metas and the Alphabets and the Amazons and the Microsofts should be front end should be at the cutting edge of leveraging AI throughout its entire workforce.
Well, I think so. I think that's absolutely the case. I mean, from an investment angle, I haven't chosen to look at them because I think they're, to a great extent, already reflecting the future that everybody knows. Because we can see that they're the people who are making they've got the huge databases which can benefit from this AI. And of course, in most of those cases that you mentioned, they're also developing the chips or the software to do it. So we can see that they are obvious beneficiaries of this. But to what extent that is reflected in the price, I think to a large extent it probably already is. But when you look around the world, there's plenty of companies who will be beneficiaries of AI, and they're only just getting started. They'll be beneficiaries of AI, not because they're making it or using it, but because they have huge numbers of staff or they have huge databases. I'll give you a very simple example. The large supermarket chains, the Walmarts of this world, for example, they have millions of customers and they have data on all of those customers. And at the moment, they're crunching it. They probably have armies of people who are processing the data, inputting it, but they'll be able to get far more out of that thanks to AI going forwards, and it'd be far easier to build the new and upgraded systems. We're going to have automated checkouts to a much larger extent than we do today. And everything is going to the product designs and the shelf designs and everything is going to change.
If you're looking for great deals on gold and silver coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's Pimbex.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
All thanks to AI. So instead of having armies of people working on this, there'll be a much smaller number of people working on all these different aspects. So you would, to start with, think of a supermarket chain as being a natural beneficiary of artificial intelligence. But just about every industry you can think of will be in some way. The question is, this is where the work I'm putting in is, which types of companies will be the biggest beneficiaries, i.e. where there's going to be a big enough impact to change those profits over time sufficiently upwards for me to look at the price and say, this is a buy of a lifetime today.
Yeah, you bring up a very good point here, especially in regards to encouraging people to become more affluent with AI. When you're dealing with AI, it's kind of an easier form of programming. And in programming, you kind of assume that you're dealing with the dumbest possible thing, which is a machine. So you've got to be very specific with your program. If you miss one semicolon, forget about it. You can have the most eloquent code, but you miss that semicolon. With AI, it's a little bit more lenient, but nonetheless, you still have to assume you're talking to a dumb person, and you lay things out very explicitly. So, these companies are all going to do what's best for their bottom line and for their shareholders. And it's not really a doom and gloom message. I don't understand the doom and gloom side of AI taking people's jobs. It actually liberates people to become more productive and become entrepreneurs. Now, all of a sudden, if you're starting your own business, you may not need to hire 10, 15 people to run your copywriting and your marketing and everything else. Just leverage AI, buy a few AI agents, and off to the races you go with much less liability than with an employee. So it actually frees people to become entrepreneurs. I mean, what do you think of that? I mean, do you see it as a more of a liberating tool than anything else, or am I too optimistic here?
Millions of people will be able to run businesses that they wouldn't have thought of or wouldn't have wanted to run in the past, thanks to the benefit of AI making life easy for them, being able to do their tax returns, being able to build their website, being able to deal with their sales inquiries. I mean, just about everything under the sun. And there are countless people who have already done this, but the numbers are going to increase dramatically. So there will be a large number of nascent one-man businesses being run, or perhaps one man running multiple businesses, where most of the hard work is done by a machine. And this is only going to get better. Every few months, I see another leap in AI's capabilities. We've gone from the simple chatbot of ChatGPT a couple of years ago, where you ask it to spell raspberry, which, by the way, it still can't spell raspberry. But
really?
Yeah, ask it how many R's there are in raspberry, and you'll. Okay,
I believe you. I believe you.
Let's do that just as a bit of fun.
What are you using? Are you using ChatGPT or something else?
How many R's are in raspberry?
The word raspberry has 2 R's, one at the beginning and one near the end.
And where's the R at the beginning?
Ah, good catch. The first R is actually right after the P, not at the very beginning. So it's in the second position of the word.
So that just shows you how wrong it can get it.
Yeah. Yeah, and this is called hallucination. It's called AI hallucination. I'm typing the same prompt right now on Grok to see if we get something different.
So one of the rules I say when you're learning prompt engineering is learn to check your responses, because they may not be giving you the true reply.
Yeah, I just did it on Grok and it gave me the same thing.
Yeah, isn't that amazing?
Very fascinating. Well, so let's take it back to investing here. How can, aside from investing in the companies that are to be at the cutting edge of leveraging AI, anything else, like from a derivative standpoint, meaning like companies, like any like natural resources, right? Critical minerals. How do you see that playing out? How do you see the commodity space playing out in conjunction with the AI play?
Well, at every moment in time, almost, there's always something happening in the world where you can jump on board and take advantage of it. And the one thing which is going on is the gold price. And the gold price has risen way beyond the expectations of analysts when they last reported or last reviewed company results 6 months ago, 3 months ago, whatever it was. So what this means is that the profit forecasts of the analysts for the relevant gold mining companies are lagging the likely reality of what those profits will be. So if you factor in a gold price, maybe you can still knock $500 off for fun. So factor in, let's say, $2,800 for the gold price instead of the current price, which is currently 3,200 and something. And when you put that in, and by the way, you don't have to do this yourself if you don't want to. This is another exercise where you get AI to do it for you very quickly. You will discover that the expected earnings of these companies 1 year from now, 2 years from now, 3 years from now, based on that assumption of the current gold price or even a lower gold price today, is higher than the analysts are currently predicting. So according to my maths, and I've worked out for a fair number of gold mining companies, there's lots of them where the price earnings ratio will next year be well below 10. And I'm talking sometimes,
wow,
6 to 9 levels, which is a very low price earnings ratio. It's a very cheap company. And that will be so let's assume the share prices don't rise. I mean, I think they will though, but let's say if the share prices don't rise, you will then have a very low price earnings ratio in a company whose earnings are growing very fast. Does that make sense? Doesn't.
Yep.
So what will happen? The share price has to rise because that's what robots do. They buy companies which are cheap with rising earnings.
Yeah, because you've got the price to earnings ratio. You've got the share price on the numerator. You've got the earnings on the denominator. And if the denominator keeps expanding while the numerator stays constant, then your PE ratio is going to start coming down. So to mitigate that, your numerator, i.e. your share price, has to
rise,
go up.
So, of course, we don't have a lot of people investing in gold mining shares yet because they've gone through 12, 13 years of seeing these shares go backwards.
What's a good ticker symbol for gold miners? Use GDX or something else?
GDX is the mainstream ETF, which follows the large gold mining companies, and GDXJ follows the junior gold mining companies. That's an ETF. So if you look at, there you are, you've got the long-term chart there going back to 2009, 2010, and you can see that gold mining stocks are below where they were in 2010, yet the gold price is significantly higher.
Mm-hmm.
So they're just starting to take off. But I think what the real money hasn't arrived yet. The real money won't arrive unless or until, well, I would not going to say unless, I'm going to say until, because I think it's more of until there's a long-term pause in the mainstream large cap stocks, the ones which every fund manager, every investment manager is buying to stay in the pack, i.e. the Microsofts, the Nvidias, the Intels, the Googles, the Facebooks, and so on. So when those large cap stocks come to a pause, and I know we're sort of in an up and down phase at the moment, so it might be looking a little bit toppy, but we don't know that yet. It's too early to say for sure. But if they do come to a sort of grinding halt and stop rising, then investment managers are going to be looking around for something which is growing, both in terms of momentum, i.e. the share price going up, well, we've got that. In terms of earnings, we've got that. And in terms of being cheap, well, we got that. So the gold mining stocks meet those three criteria. So I think that's where the opportunity arises is at the moment. But, just to sort of say every moment in time, there's always something out there which looks like an opportunity. So I'll give you a few examples to.
Right. And we've got GDX versus the gold price here, and it's like you said. I mean, when you compare the two on a ratio basis, GDX has been down in the dirt. Now, this is the logarithmic scale. If we go back to a nominal scale, so we've been kind of coalescing around this wedge pattern here, and we are, we've touched this line multiple times. We've tested it. We've tested resistance multiple times, and I mean, is this the time that it goes up? But I don't know. But it is relatively undervalued.
What we're seeing from your chart there is that an ounce of gold will buy you 3 times as many gold shares as it would have done in 2008 or 2009. What that means is gold shares, mining companies have significantly underperformed for a decade or so. And now, obviously, people are going to say, well, if they've underperformed a decade, they're probably going to carry on underperforming. I don't think that's true. I mean, we only have to look at the period from 2000 through to about 2011 or 12, and we'll see, I don't think you'll do the GDX for that one, but you'll see that the gold price in that period went up many hundreds of percent to 200 or 300%. And in the same decade, the S&P 500 had a negative return.
I see. So I've got the Huey up. This is the Gold Bugs Index. So because GDX doesn't go back beyond 2007, but what I'm going to do is I'm going to transpose or juxtapose S&P right next to it. So if you go, it really all depends on your starting point. You said 2000?
From 2000 to 2010 or 12, you'll see that there's a negative return on the S&P 500. There's a several 100% positive return with gold.
Yeah, so if you make 2000 your starting point, gold sees 465% returns over.
I mean, if you take that out to 2011 or 12, you'll see the return is something approaching 300 or 400% on gold at a time when stocks went nowhere.
Yeah, and stocks were minus 6%. this is what's giving me here.
Yeah,
So,
it depends on what starting date you use, but I come up with -12, I think, for the S&P, but it depends on the date.
So you got the S&P here down in pink, just an FYI.
That's right.
And the Huey up here and the candlesticks.
So at the moment, we've got both the gold price and stocks heading north. But as I say, if the stocks stall, that will, I think, drive people into the gold mining stocks. It won't stop. I mean, the gold price. I think the gold price will carry on upwards, whatever happens. Because it's very well supported by central banks. There's a lot of nervousness about. Well, not nervousness. There's a certainty that you will never get repaid if you own government debt in something which will buy you the same sort of value as it buys today, at least not in the sort of things you might need as a retired person, like healthcare, a nice house, some paintings on your wall, a nursing home, those sort of things. You know, all the luxuries, the cruises, the sort of things you've been saving up all your life for. They're going to cost. The price of those are going to go up by more than the CPI, because we mustn't forget the CPI comprises a lot of things which are made by robots, and therefore are not really rising to the extent that government debt is rising. Government debt, it's rising by 7%, 8% a year, roughly. That's the real inflation rate.
Yeah, so let's do this. Let's pull up gold. And let's compare it. Let's look at the U.S. debt side by side. So if we say U.S. federal, or is it economy, federal debt, whatever it's called.
Federal debt, total public debt, USDT.
USDT, okay.
In the middle, I think, of your screen, middle of your screen.
Oh, here it is. Oh, just it?
One up.
Oh, okay. Sorry about that. All right, where is it?
You'll have to do it monthly okay.
Yeah, so we don't have any. Interesting. So let me switch this up. I'll just edit this part out just so it stays. Okay, USDT, is that the one we picked?
Yes, United States government debt.
Okay,
yes.
Here it is. Very good. So let's clear all these.
Comparing that with the gold price at the moment, obviously the gold price is moving ahead. But if you look at the chart, you can see the acceleration upwards of government debt, and that's because it's going out of control at the moment. I'm not saying we're already in a death spiral, but I think it's inevitable. We will get into a death spiral in many countries, and it might well be happening in Japan already.
Yeah. So here they are side by side. You've got the U.S. debt up above in purple, and then you've got gold here down below. And I mean, both have been ripping higher. Gold's been parabolic recently, the last couple of years. The U.S. debt maybe gold's an early indicator for bad news on the U.S. debt front. Maybe it starts going parabolic as well.
I think what's also going on is that large countries like China and probably India as well can see that the writing is on the wall for the present system that we have. In 1944, we had the Bretton Woods Conference, and whether this was expected by the participants or not, what actually happened was the United States said, look, we've got the most gold. Why doesn't everybody go on to forget about a gold standard, which is very inconvenient because you're moving gold across the oceans with all the risks and work and costs. Why don't we go onto a dollar standard, and we will be willing to exchange your dollars and everybody's dollars for gold on demand. So the whole world in 1944 went on to this gold standard, or rather the dollar standard, which was effectively backed by gold. And that worked perfectly up until 1971, when more and more countries were saying there's too many dollars out there compared with the gold you're holding. Let's convert our dollars back to gold. Thank you very much. And so in August 1971, Nixon closed the gold window. It's sometimes known as the Nixon shock. And from that date on, the gold price traded freely. But of course, the fact was there was already a lot more debt out there than could have ever been serviced by the gold that the United States had. And of course, the gold price then took off and has barely looked back since. So, but the trouble is, we're now at the end of the road, I think, with the current system, and it's time for a new system. And a natural new system, in my opinion, might be some sort of gold-backed system. So whether that comes out of the BRICS nations, I'm suggesting a hypothetical situation, but let's say countries like China have a lot more gold than they say they have, which is a possibility. We don't know. And the BRICS nations get together and agree that they will have a monetary system backed by gold, of which China will be the holder of gold and issue all the renminbi, and everybody can, or maybe it'll be a new currency. It'll be the BRICS currency, and everybody will change their money backwards and forwards electronically, which is far more convenient than moving the gold around. But if there's a trade imbalance, that BRICS currency can always be converted back to the gold, which is held by a central bank for the BRICS nations. This could be coming, and of course, it could be coming for the United States. So, what would happen? Let's imagine some event happens tomorrow, and you wake up on Monday, and you suddenly have an announcement from the president: we're now on a gold dollar. And by the way, there's a temporary restriction on converting your old dollars to the gold dollar.
Well, I mean,
so
that would cause
those who've got the gold will be fine, but those who don't will be scrambling around to see if they can get some, because that's the only thing you'll be allowed to spend.
Do you think it happens in one night, though? Like, wouldn't they try to ease it in with a little bit more finesse?
Everything's possible. Let's look at it. It's happened in one night before in the United States. Let's go back to before they called in the gold with the executive order of 6102 in 1933, which I think was on the 5th of April, 1933. But about 2 months before that, with the stroke of a pen, Roosevelt closed the banks for 2 weeks. When the banks opened, everybody who was in the know said, oh my God, America's in trouble. We might not be able to get our gold anymore, which actually did in fact happen. So what did they do? They couldn't get the gold out of the banks because the banks were all nearly bankrupt and didn't have the gold and weren't handing it out anyway. So what did they do? They rushed into the stock market. The stock market that day had the biggest gain in all of history, and then proceeded in the next few months to go on and increase by another 100%.
It was the next best thing.
It was the next best thing because you couldn't get your hands on gold. And then a month or two later, on the 5th of April, he basically issued this executive order saying, I order everybody to hand in their gold. You're not allowed to have gold. We're still on a gold standard, but you can't have it. So it wasn't really a gold standard at all. And then we had another overnight event on the 31st of January, 1934. They devalued the dollar on the 31st of January 1934 by nearly 50%. So, but what did they do the day before that? The day before they devalued it, they said to the government passed a law ordering the Federal Reserve to turn over all its gold in exchange for government notes at the official price of $20.67. The next day, the US government revalued the dollar at $35, and the Federal Reserve was mightily pissed off that it missed out on this huge profit, which was booked as a profit.
Revalued, you mean revalued gold, right?
Revalued gold. Actually, what they did, we all say they revalued gold, but what they actually did technically was reduce the amount of gold in the dollar, because the dollar was gold. So if I don't know, I remember how many grains of gold. Let's say it's 40 grains. They reduced it to 20 grains or 25 grains. So basically what that meant was that the Federal Reserve had missed out on billions of dollars of profit overnight. But it wasn't just the Federal Reserve who lost out. All around the world, bankers in Paris, in London, in Zurich, who were holding some dollars, suddenly found their dollars were worth that much less. And that happened in one night. And, another example of that is when the euro dropped by literally within a few seconds, 30% against the Swiss franc. I think it was about 2015. Now, actually, it was the Swiss franc which broke the peg. So Switzerland was on a peg to the euro at a fixed rate of 120, i.e., 1 Swiss franc and 20 cents would buy you a euro. And that was a peg. And then one day, without any warning and in market hours, the central bank of Switzerland said, we're no longer going to support this peg. And within seconds, the euro plunged, or if you like, the Swiss franc soared, and it went from 1 Swiss franc 20 to buy a euro down to about 80, 90 cents in seconds. And then it bounced around and it settled around 105, 106. But that was another example where a currency can change its value rapidly. And then, of course, let's not forget when Great Britain dropped out of the ERM, the exchange rate mechanism. So Britain was trying to become part of the euro, and it was becoming tougher and tougher because everybody knew that Britain's finances were a mess. Their debt was increasing, and they were struggling to keep the pound in the there was a band, I forgot what it's called, the exchange rate mechanism band or whatever, something like that. And then we had George Soros come in and start betting billions against the pound. And finally, the Bank of England gave up and the pound plunged, I think it was 20 or 30% in a day as they suddenly said, we're not supporting this anymore. So we can have huge currency lurches. And yes, so it could happen that overnight we suddenly find ourselves on the new gold standard, where we've got two currencies operating. We've got the gold dollar and the old dollar, but the old dollar isn't going to be worth 1-to-1 against the gold dollar.
I want to ask you: do you think that they could pull off another gold confiscation route, or not? Given it would be much more difficult in today's day and age. But before we get into that, I want to show you something I just pulled up here. So I drew these lines here across our graphs. Again, we do have the the federal debt here in purple or pink, and then at the bottom we have the gold price. But what you'll notice is that whenever the federal debt starts to inflect upwards, like you did here and here, you have this inflection point in terms of the rate of change on the federal debt. What you'll notice is that gold rallies in sequence to it. So from this inflection point to this inflection point, you had this massive move up in the price of gold. From this inflection point to that inflection point, again, a massive move up, a continuation up. But when things started to slow down, i.e. decelerate, gold had it pretty much moved in a sideways. It came down and it corrected back up again, all the way up until recently when it inflected back up. And now we are in the midst of the move that we're in. So,
well, if you look at the last 5 months on your graph, you can see on your chart, you can see that there's been no growth. That's because the debt ceiling has been hit. But as I said, come July, August, maybe September at the latest, they'll have to raise that debt ceiling. And at that point, as they replenish the coffers, refund the pension funds what they owe to the pension funds, what they should have paid in and haven't, at that point, the US debt is going to take off again.
Yeah. And it kind of begs the question, is the gold price pricing in this federal debt chart just to skyrocket? Because again, it has reached its ceiling. It has reached the federal debt ceiling, but gold's continue to rally as if that doesn't matter. So I wonder if there's
I think, there's clearly something which nobody, well, we don't know, and it's not published anyway. Something is going on in the gold market that I don't understand and nobody seems to understand. And there's lots of speculation and theories, but if you look at the gold deliveries in COMEX, you will see that every month this year, there are at least 200% higher than the equivalent month last year. So that means each month the deliveries are 3 times what they were a year ago. This month, which is May, we're only halfway through it. The deliveries are 700% higher than May last year. So someone somewhere is taking delivery of huge quantities of 100-ounce bars. That's 330,000 a bar. Someone is taking delivery of huge quantities of physical bars, and there's been all kinds of speculations to, one, who it might be or why they might be doing it, but we still don't have an answer, and we're months into this. But those bars are disappearing into some physical vault or somewhere who might in the past have been happy rolling over the futures on COMEX. They're taking delivery. Question is, who are they doing? Who is it and why? I don't have the answer. I can speculate to the heart's content and tell you all the theories, but some people say it's the US government stocking up on gold because they're going back on a gold standard. Some people say it's Canada who hasn't got any. Some people say it's Warren Buffett or Berkshire Hathaway because they've got billions and they've already made a few negative noises about the dollar and owning bonds. Some people
maybe it's
speculate.
Who knows?
It might be Mexico. Nobody really knows. It might be a whole bunch of hedge funds all acting in concert. But whoever it is, first of all, doesn't seem to care that they're paying all-time record prices, and they haven't stopped. It wasn't a one-month thing. It happened in January, but now it's February, March, April, May, and it carries on.
You make a really great point there, because that sense of urgency, where complete disregard of the all-time high price, tells you that, like, are we about to see like an emergency, like down the line? Like, do they know something that we don't know? If they're willing to just buy it unambiguously, indiscriminately, it's very weird.
I think we do know it. We know that the present system cannot continue forever. What we don't know is the timing of when it comes to an end, but we can speculate, and I think it's a pretty good guess that we're at 5 minutes to midnight.
All right. Well, if you don't mind answering the last question before you wrap up here, Clive, do you anticipate another gold confiscation down the pike here, or can they not pull something like that off in today's day and world?
I don't think a gold confiscation would make any sense unless the government has to pay its bills in gold. The reason they had the 1933 confiscation was twofold. First of all, the economy ran on gold and the banks were being emptied because the government had too much debt. So people didn't trust the banks, they didn't trust the government, so they were withdrawing all their money in physical gold coins. So the wheels of the economy were not being greased because there was no gold in the system. It was under everybody's pillow. And the second thing was the government was paying its bills in gold, and the coffers were slowly emptying, so they wouldn't have had enough gold to pay the bills. So we don't pay our bills. No government pays its bills in gold today. So why would they need your gold? So I don't think it's going to happen. I think it's unlikely.
Okay. Well, that's reassuring, given that pretty much my entire audience are gold bugs. So that's good to hear. Clive, it's been a pleasure having you on as always, my friend. Anything else you want to talk about before we wrap up here?
Thank you, Danny. Well, I'm starting my own YouTube channel. There's a couple of videos up. Look for me on YouTube, and I'll be putting up. I'm going to be talking mostly about stocks. I will be talking about gold, and I will be talking about gold mining stocks as well. But I talk about stocks in general and investing in general. I've been investing now for 50 odd years. And those people who follow me on LinkedIn, many of them have asked me for a copy of the spreadsheets, which I published on LinkedIn on the 1st of January or the 31st of December 2023 and 31st of December 2024, which were investment portfolios. Hundreds of people have had that spreadsheet. They can all see that the stocks picked for last year and the stocks picked for this year are immensely outperforming every benchmark on the planet. So the 55 stock portfolio of 2024, I've got it on my screen in front of me, is up 25% this year, 24.99 to be precise. The 2025 portfolio this year is up 18.03, and the S&P is up barely 1%.
Yeah.
And the Nasdaq's down.
Very good.
It's not that it takes a lot of courage to publish a portfolio at the start of the year, because people will laugh at you if you get it wrong. But I've been doing it so long, I'm willing to take my chance. And I will be talking about how to pick stocks, how to choose stocks on my YouTube videos. And anyone who wants to find out, look for my name on YouTube.
All right. Well, we will have the link to your channel down below in the description box. So if you guys are interested, I encourage you to check it out and hit the subscribe button. Subscribe to Clive. You're at what, 6,000 subs now or something, Clive?
Yeah, I think it's 6,000 people now, and I've only done about 3 or 4 videos since I started.
Well, let's get Clive up to 10,000 at least. So hit that subscribe button, guys. I'll have the link down below to his YouTube channel. If you enjoyed this podcast as well, be sure to hit our subscribe button too, and drop us a like and write "Go Clive Go" in the comments section. If you agreed with Clive's analysis, if you disagreed with anything, that's perfectly fine too. But let me know what you disagreed on. I do, in fact, read the comments. So drop me your thoughts down below. Also, check out our good sponsors and friends over at the Trends Journal. It's Gerald Salente's Trends Journal. You get access to his huge 100+ page trend reports. They're a massive data dump, so you don't have to go out there and read the news and gather intel on your own. Gerald Salente and his team does it for you. We have a special 10% discount down below, so be sure to check that out as well. To supporting the link, supporting the Trends Journal also helps support us. And then check out my Substack at capitalcosm.substack.com to get early access, ad-free versions, and uncensored versions of all my videos for the YouTube audience. So, all right, guys, it's been a pleasure. Till next time. Bye.
Thank you. Bye-bye.